Greetings, it is time for a CrashWatch video because we have not done one in quite some time, and things are entering uncharted territory relative to classic market analysis in that I started doing those CrashWatch videos earlier, in early 2022, and everything was following a very standard script based on the central banks of the world deprinting, which they should not be doing, but they're doing anyway, deprinting, and I said that the ultimate bottom would be in the low 3,000s or so because that was still an all-time high in 2019. Now when the bottom is the all-time high of 2019, that isn't expecting too much. And things were going this direction, but it couldn't get much lower than 3,700 over here. Because, despite all this tightening, there's this AI boom going on which has pushed all of technology higher, and the ability to intake new technologies is getting faster and faster. Now this leads to some fundamental questions about whether the economy has entered into a new age based on higher productivity, or this is just like late 2000. If you look at the dot-com bust, there is more interest going in, but the internals are weakening. And let's examine both. Despite everything I believe about technology and the fact that AI is my specialty, I don't think we have gotten to a point where the market will never go down again, that is for sure. A lot of the AI money is also going towards anything and everything and is not going to the most productive sources, number one. Number two, there are always certain types of technological hype bubbles, but that cannot counter the fact that the central banks are deprinting money and tightening and raising rates in a relatively crazy fashion, especially since inflation has stopped quite some time ago. The brief period of high inflation was more than 1 year ago, as you can watch in the video I published right before this one, which is this one up here in the upper right hand corner. But the yield curve is inverted and mortgage rates are rising, which is extremely negative for the housing market. So let's look at the yield curve next. This is the difference between the Fed funds rate and the US 10-year Treasury yield. And I've spoken about this on this channel before. However, when the yield curve is inverted, that destroys the business models of banks in the United States. And that's why Silicon Valley Bank, which I spoke about in this video up here in the upper right-hand corner, as well as First Republic Bank, which I spoke about in this video in the upper right-hand corner, imploded and had to be rescued by the Federal Reserve. An inverted yield curve is very negative for the business models of banks. Now, the bigger banks can last longer, but the area enclosed by this negative amount is rising. I spoke about that over here, and then also more recently as well. But this delta of minus 1.24% and going on for more and more time, weeks and months, is increasing this area, which is more pressure on the entire business model of banks, independent of what is happening in technology and artificial intelligence. And when the financial sector goes down, everything goes down. Technology might recover faster, and that is a great entry point if that were to happen. But this cannot be ignored just because there's another tech hype cycle going on in artificial intelligence, even though that is the field that I'm involved in my normal career. So consider that. The Federal Reserve is still raising interest rates and deprinting money, and the central banks of other countries are also deprinting money. When the Federal Reserve raises interest rates, this spread becomes more negative unless the 10-year yield also rises. And the 10-year yield has also risen somewhat to keep this spread from getting too high. But you know what that means? That means mortgage rates are rising. So let's go there next. 30-year fixed rate mortgage average in the United States, 10-year chart. Things were perfectly fine from 2014 through 2019, but the COVID-19 crisis necessitated a lot of money printing. Unfortunately, the Federal Reserve does money printing in a super concentrated, distortive way, rather than send cash directly to people where it would have actually helped the people in need. Instead, it just buys up more mortgages so that people who have mortgaged houses make more and more home equity, and the bigger the house you have, the more home equity you make. So it truly ensures that money printing concentrates to the richest. But then when they tighten, they make the mortgage rate rise again. Now the rise from here to here may not be that much, but the fact that it was this low got some first-time buyers trapped in this mortgage rate, and unless they made it fixed at this rate forever, they are going to get adjusted upwards. Also, there's no new buyers because a higher mortgage rate means that the payments are more and the price of the house that people will actually be able to purchase goes down to compensate for the higher mortgage rate. I've explained that in multiple videos on this channel as well. A low rate is not a great deal because the price of the underlying home rose in proportion, and a high rate is not a terrible deal for the first-time buyer because the underlying home price probably went down. So the thing to do is to purchase when rates are high. Then as rates lower, your home equity rises and you finance to a lower rate. That's the big trick in America, for those who didn't know that. However, when buyers go away, then construction jobs go away, and you get that banking crisis that I spoke about a minute ago because these mortgage rates are too high. If you want to go even further back, from 2003 to present, the previous housing bust was not even that much of a rise. That huge housing crisis that we heard about in the news, 2007, 8, and 9, was not even that much of an increase in mortgage rates. Nonetheless, we saw that type of catastrophe. Here we have mortgage rates rise by an unprecedented amount at a time when the yield curve is also inverted and the Federal Reserve is still tightening. So this is very bearish for the S&P 500 and the Nasdaq as well. We don't know when it's going to crash, but this pressure is accumulating, and when it breaks, it finally breaks. Until the Federal Reserve stops raising rates and in fact lowers rates, which they only do on a reactive basis after there's a crisis rather than to avoid a crisis, this pressure will continue to be on the market. And therefore we should still expect an S&P 500 correction for this reason. Thanks for watching.